let's go back to our picture. We have profits, value, and leverage, right? Again, leverage in the x-axis, value and profits in the y-axis. If you think about tax benefits, what we've shown with the PepsiCo example is that your after-tax profits are going to increase with leverage. So PepsiCo becomes, or any company that is profitable, will likely become more profitable as leverage increases, right? This increase in profitability will also increase the company's value. So I plotted the value here as well, instead of just profits as we were doing before. However, we also learned about cost of financial distress. As your leverage increases, what will happen is that the risk of bankruptcy, the risk of financial distress is going to go up, right? If financial distress happens, then all of those bad things happen. The bad things we talked about, the company has to refinance, they have to issue equity, cut investments, right? These actions will tend to reduce the company's value. What this means is that as you increase leverage, value goes down through this financial distress channel, right? If you put the two pictures together, what we get is what we call the trade-off model of capital structure. It's the trade-off between the tax benefits of debt and the cost of financial distress. So the way that companies should choose their optimal leverage, the optimal amount of leverage to have, is by trading off the positive effect of taxes on profits with the negative effect of leverage on financial distress costs. Okay? What you get is a picture that is going to give you, presumably we're going to give you an optimal leverage ratio that we call L star here. That would be, in this case, that would be the optimal amount of leverage that a company would have. Okay? So this is all very nice theoretically, right? And here we bring back our researcher again. How does this figure look like in the real world, right? That's what we are interested in, a very nice theory, but let's see if we can figure out how this picture looks like for real world companies. This is done in a very nice paper by a researcher called Arthur Korteweg. What he does is he estimates exactly that picture, the effect of leverage on value for firms of different characteristics. Okay? And this is what Korteweg finds. Korteweg finds that there is a picture like that in the real world. There is an optimal capital structure, which, as we talked about already, the average firm has a leverage of about 30%. Korteweg finds that the average firm tends to have an optimal capital structure. And here's the important number. The average firm in the US, the average company in the US, tends to gain 5% in value by moving from a leverage of 0, by having no debt, to a situation where you have 30% of debt. Okay? So you would gain 5% in value by moving from 0 debt to 30% leverage. That's how this picture would look like in the real world, according to Korteweg. Okay? And then, of course, this is just an average picture. Not all firms are going to have the same optimal leverage. If you think about the model we just described, there are many variables that are going to be important, right? For example, the volatility of cash flows. Financial distress is going to happen if the company's performance becomes poor, right? So riskier companies that have higher cash flow volatility, are going to have a higher chance of becoming financially distressed. The tangibility of assets matters as well. If a company becomes financially distressed and you have very tangible assets like land, right? It's going to be easier for a company to raise financing by selling the land or by borrowing against the land. So tangibility should also reduce the cost of financial distress. Profitability, right? Profitability also matters because, as we discussed it, only profitable firms should really have tax benefits of leverage, right? If you don't have any profits to shield, there's no tax benefit to take advantage of. Size also matters, right? Think about financial distress. If a large company becomes financially distressed, it's probably going to be much easier for a large company to access financial markets and refinance debt, issue new equity, than for a small company. right? So size should also affect this trade-off. And finally, the company's valuation. This is something we talked about in Corporate Finance 1 as well. It's the market-to-book ratio, right? The market-to-book ratio, essentially what it measures is, it measures whether the company's value lies in the future, right? Where the future profits matter a lot for this firm, right? So if you think about the market-to-book ratio, what should be the case is that companies with high market-to-book ratio have a lot more to lose if they become financially distressed, okay? So one way to think about these characteristics, for example, thinking about volatility, right? We have that picture that we showed you for the median firm from Korteweg's paper. The median firm will have an optimal leverage ratio of 30% and will be getting 5% of value by moving to the optimal leverage ratio. If a firm has high volatility, then this picture will be shifted lower, right? The high volatility, the high risk firm will not have as much benefits of having high leverage because of the increased risk of financial distress. Okay, so the picture shifts down, meaning that optimal leverage is going to be lower for a firm with high cash flow volatility. Okay? The problem is that now we reach the limitation of what we know from the research. We have this very nice model that describes capital structure, and it seems to be consistent with real-world capital structures, but what we don't know is how much, going back to that picture, what we don't know is how much lower should the leverage be, right? You can, if you look at that picture again, you'll see that we had a question mark. We really don't know how much lower should the leverage be for the firm with high cash flow volatility. One way to think about this is that the trade-off model is not good enough to give us a precise quantitative model of capital structure, but you can still use the trade-off model as a qualitative model, right? So as we discussed it, right, we have the median firm has an optimal leverage ratio of 30%, but firms with high cash flow volatility, low tangibility, small size, etc., should have less debt, right? So you can use this model as qualitative guidance for how much leverage a company should have in the real world, and what the research has shown is that by and large these characteristics do seem to predict variation in leverage ratios in the right direction.